The yield curve, a precursor to market downturns and economic collapse. Introduction. The yield curve. It sounds technical, almost boring, but in reality, it is one of the most powerful warning signals in all of economics. It is not flashy. It does not make headlines every day. Yet, time and time again, it has quietly appeared before major market crashes, recessions, and periods of economic pain. The yield curve represents the relationship between short-term and long-term interest rates on government bonds. In normal times, it slopes upward. Long-term bonds offer higher interest rates than short-term bonds because investors expect to be compensated for tying up their money for longer periods. That upward slope signals confidence in growth, confidence in the future. But sometimes, the curve flips. When short-term interest rates rise above long-term rates, the yield curve becomes inverted. And when that happens, history tells us something important. Trouble may be coming. In this video, we're going to break down what the yield curve really is, why an inversion matters so much, and why it has repeatedly warned us before economic downturns and market collapses. Part 1. What the yield curve really means. To understand why the yield curve matters, we first need to understand what it shows. The yield curve plots interest rates for bonds that all have the same credit quality but different maturities. On one end, you have short-term bonds, like 1-year or 2-year bonds. On the other end, you have long-term bonds, like 10-year or 30-year bonds. In a healthy economy, the curve slopes upward. This makes intuitive sense. Lending money for 30 years carries more risk than lending it for 1 year. Investors demand higher interest as compensation for that uncertainty. An upward-sloping yield curve tells us that investors believe the economy will continue growing. It reflects optimism, stability, and confidence in long-term expansion. But when that confidence fades, behavior changes. An inverted yield curve occurs when short-term interest rates move higher than long-term rates. In other words, investors accept lower returns for long-term bonds than for short-term ones. That is not normal behavior. And when it happens, it sends a message. Part 2. Why the curve inverts. Short-term interest rates are largely controlled by central banks. When inflation rises or the economy appears to be overheating, central banks raise short-term rates to slow things down. Higher rates make borrowing more expensive. Spending slows. Investment slows. At the same time, long-term interest rates are driven by expectations. If investors believe economic growth will weaken in the future, they move their money into long-term government bonds. They do this because those bonds are considered safer during periods of uncertainty. As demand for long-term bonds increases, their yields fall. When rising short-term rates collide with falling long-term rates, the yield curve inverts. This inversion reflects a shift in sentiment. Investors are essentially saying, "We believe growth will slow, inflation will fall, and future conditions will be weaker than today." That expectation is what gives the yield curve its predictive power. Part 3. Historical warnings from the yield curve. The yield curve earned its reputation the hard way. Let's look at history. The 2008 financial crisis. In 2006 and 2007, the yield curve inverted. At the time, the Federal Reserve was raising interest rates to combat inflation. But beneath the surface, problems were already building. The housing market was overheating. Mortgage lending had become reckless. Financial institutions were heavily leveraged. The inverted yield curve was one of the earliest signs that the economy was under strain. Soon after, the housing bubble collapsed. Banks failed. Markets crashed. The global economy entered one of the most severe financial crises in modern history. The yield curve did not cause the crisis, but it warned us. The dot-com bubble and the 2001 recession. In 2000, a similar pattern appeared. Technology stocks were soaring. Valuations became extreme. The Federal Reserve raised interest rates to cool the economy. Once again, the yield curve inverted. Investors sensed that the tech boom was unsustainable. Shortly after, the dot-com bubble burst. Stock markets plunged, particularly in internet-based companies. The economy entered a recession in 2001. Once again, the yield curve had quietly signaled danger ahead. The 1990 recession. The yield curve also inverted in 1989, ahead of the recession in 1990. This downturn was driven by rising oil prices, geopolitical instability, and tight monetary policy. While it was less severe than later crises, the yield curve still provided an early warning. The pattern remained consistent. Part 4. Why the yield curve is a leading indicator. One of the most important things about the yield curve is that it looks forward. Most economic indicators are lagging. Unemployment rates, GDP growth, and corporate earnings tell us what has already happened. The yield curve reflects expectations, central bank policy, and market reactions. When central banks raise short-term rates, borrowing becomes more expensive, businesses slow hiring, consumers spend less. If investors believe these policies will push the economy into a slowdown, they react before the damage appears in official data. They buy long-term bonds. They reduce risk. They prepare for weaker growth. The yield curve captures this collective judgment in real time. Risk aversion and the flight to safety. An inverted yield curve also reflects fear. When investors expect uncertainty, they move away from risky assets and toward safe ones. Long-term government bonds become especially attractive during these periods. This surge in demand pushes long-term yields down, reinforcing the inversion. In simple terms, the yield curve shows when investors are preparing for economic trouble before it becomes obvious. Part 5. Does the yield curve still work today? In recent years, the yield curve has sparked debate. Brief inversions occurred in 2019 and again around 2020. These periods were followed by unprecedented events, including the COVID-19 pandemic and massive central bank intervention. Some argue that policies like quantitative easing have distorted bond markets and weakened the yield curve's reliability. But even in this modern environment, yield curve inversions still reflected genuine concern. They signaled slowing growth, rising uncertainty, and fragile economic conditions. While the yield curve may not predict the exact timing of a recession, its historical accuracy remains difficult to ignore. Conclusion: the yield curve is not just a line on a chart, it is a reflection of confidence, fear, expectations, and collective market psychology. When the curve slopes upward, it signals optimism. When it inverts, it warns that something may be wrong. From the dot-com crash to the financial crisis of 2008, the yield curve has repeatedly appeared before major downturns. It is not perfect. It does not predict exact dates,